All right, today we're going to pull back the curtain on one of the biggest secrets in trading. And I promise you, once you get this, it is going to completely change the way you look at a chart. We're talking about the hunt for liquidity. But first, let me just ask you a question. Do you ever get that sinking feeling that the market is personally out to get you? Like it knows somehow exactly where you put your stop loss? Us. You know the scenario, right? You've done all your homework, you place a trade, you set a totally reasonable stop loss, and then the price, it just makes a beeline straight for your stop, takes you out to the absolute tick, and then, would you believe it? It reverses and just rockets in the direction you thought it would go. It is so frustrating. Well, this little phenomenon actually has a name. It's called a stop hunt. And yeah, it makes a ton of traders feel like they're just getting played. But what if I told you there's a totally logical reason this happens? Here's the absolute truth: the market is not hunting you, it's hunting something much more valuable. This isn't some personal vendetta, okay? It is simply business. And the business of the market, well, it runs on one thing, and that one thing is called liquidity. I want you to think of liquidity as the fuel, the gasoline that makes the entire market engine run. Without it, the biggest players in the game, they can't even make their moves. Just look at the difference in scale here. For a retail trader, you or me, liquidity is basically never an issue. We click buy and poof, our order gets filled right away. But now, I want you to imagine you're a giant financial institution and you're trying to buy, say, $100 million worth of something. You've got a massive problem. You need to find people on the other side of that trade who are willing to sell you that much. And that kind of volume, it's just not sitting around waiting for you. So, what is liquidity really? Well, it's just a big concentration of orders. It's an area on the chart where a whole bunch of pending buy orders, sell orders, and this is the key part, stop loss orders are all clustered together. Now remember, a stop loss is just an order to automatically close your trade. So every time a stop loss gets hit, that trader is forced into the market, either buying or selling. And that is the fuel the big institutions need to fill their giant orders. And this brings us to what might be the single most important sentence in this whole explainer. I really want you to burn this into your brain. If you can't identify the liquidity, then you are most likely the liquidity. Your stop loss is part of the fuel that's moving the market. So, the big question is, if we want to stop being the fuel, what do? We have to learn how to see the market the way the institutions do. We need to learn how to map out these big pools of liquidity. And here's the secret: these liquidity zones, they're hiding in plain sight. They're actually the exact same patterns and levels that most retail traders are taught to use. Equal highs and lows, swing points, those obvious trend lines, classic support and resistance. These are all the places where traders put their entries and, you guessed it, cluster all their stop loss orders. Let's just break this down with a super classic example: the double bottom. It's a pattern every single trader learns in like their first week. So you have two completely different ways of seeing the same thing. The retail trader, they see a textbook buy signal. They see the strong support level, they're getting ready to go long, and they place their stop loss right below those two lows. Makes sense, right? But what does the institution, the so called smart money, see? They see a giant flashing neon sign that says liquidity here. They see a huge pool of stop losses, which are basically forced sell orders that they can use to fill their own massive buy orders. So you have to remember this: the price isn't actually attracted to the support level itself. No, it's attracted to that big pool of stop loss orders sitting just underneath it. That liquidity, it acts like a powerful magnet, just pulling the price down far enough to trigger all those stops before the real move actually begins. Now, sometimes there just isn't enough natural liquidity sitting around at these levels, and that's when the institutions get even craftier. They don't just hunt for liquidity, they actively go out and create it. This is a little trick called inducement. It's when the market makes a small, kind of early move near a key level, making it look like the big move is starting without you. It's designed specifically to trick impatient traders into jumping in too early, because when they do that, they place their stop losses and boom, they've just created or engineered a brand new pool of liquidity that the institutions can then go after. It is a deliberately set trap. Okay, so we get it. We've identified the problem, we understand why it's happening. But how do we turn all this knowledge into an actual strategy? How do we go from being the hunted to being the hunter? All right, here is the hunter's playbook. Step one: identify the trend. First things first, you always have to know the overall direction of the market. Step two, map the liquidity. Get out your drawing tools and start marking those obvious zones where you just know stop losses are piled up. Step three, wait for the sweep. This is the hardest part, patience. You have to just sit on your hands and wait for the price to attack that zone. Step four, spot confirmation. So once the sweep happens, you look for a sign of reversal, maybe a big rejection candle, something that shows momentum is slowing down. That's your signal. And finally, step five, plan your entry. You only get in after the trap has been sprung, not before. When you shift your whole perspective like this, everything changes. You're no longer the person who's providing the fuel for the market. You're the one waiting for the institutions to fill up their tank, and then you're just hopping on for the ride. You start trading with the flow of smart money instead of constantly fighting against it. So let's bring this all back to that one core question. It's a question I want you to ask yourself every single time you look at a chart from now on. Now that you understand the game that's being played, that the market is just this constant hunt for fuel, what are you going to do differently? How are you going to position yourself so that your stop loss doesn't become just another drop of gasoline in somebody else's tank? Because at the end of the day, it all comes down to this one simple truth. You're either the one who understands where the liquidity is and you use it to your advantage, or you are the liquidity. The choice is yours.